You're paying 40% more for gold than you should. Kitco won't tell you this. Neither will your dealer. But the spread between what you see and what you pay is where the industry makes billions. And today, I'm exposing exactly how this works. Here's something that should make you angry. When you check Kitco for the gold price, you're seeing what's called the spot price. That's the wholesale rate for 400-ounce bars traded between banks and major institutions. But here's the open loop I need you to remember. You will never, ever pay that price. Not even close. The gold industry has built an entire profit structure between that spot price and your wallet. And by the end of this video, you'll know exactly where every dollar goes. But first, understand this. Kitco isn't just a news site. They're also a dealer. And that creates a conflict most investors never question. When the same company telling you gold is about to skyrocket also happens to sell gold, that's worth examining. The real question is how much this information asymmetry costs you. And the answer might shock you. Let's break down the gold supply chain because this is where the education begins. Gold gets mined, refined into bars, then sold to wholesalers, then to dealers, then to you. Every single step adds margin. Mining companies need 20 to 30% margins to stay profitable. Refiners take their cut for processing and certification. Wholesalers add logistics and insurance costs. Dealers layer on retail premiums, marketing, and overhead. And here's the first revelation. When premiums spike, it's rarely because gold is scarce. It's because demand surged and dealers can charge more. In 2020, 1-ounce gold eagles carried premiums over $200. The spot price didn't justify it. Panic buying did. If you understand this pattern, you stop buying emotionally. You start buying strategically. And that knowledge alone could save you thousands over your investing lifetime. Think about that for a second. Now let me shift your perspective entirely. Most people check Kitco, see gold moving up, and think they need to buy immediately. But here's where it gets counterintuitive. The best time to buy physical gold is often when nobody's talking about it. When mainstream financial news ignores precious metals, premiums compress. Dealers need to move inventory. Competition drives prices down. But when CNBC starts running gold segments in Kitco's traffic spikes, premiums expand rapidly. You're essentially paying a popularity tax. The data proves this consistently. During the 2011 gold peak, premiums on American Eagles hit 15%. By 2015, when gold sentiment was rock bottom, those same coins carried 4% premiums. Same product. Same weight. Same purity. Massively different cost. The contrarian approach isn't just philosophy. It's mathematics. And the numbers don't lie. But there's something deeper happening that affects every gold investor. And this is where banks don't want you looking. The paper gold market is roughly 100 times larger than the physical gold market. Let that sink in. For every ounce of real gold sitting in a vault somewhere, there are claims on 100 ounces in derivatives, ETFs, and futures contracts. This creates a strange dynamic. The spot price you see on Kitco is determined primarily by paper trading, not physical supply and demand. When institutions trade gold futures in massive volumes, they move the price. But when you buy a physical coin, you're in a completely different market. This disconnect explains why premiums can stay elevated even when spot prices drop. Physical demand operates on its own logic. And understanding this separation is crucial because it reveals why following spot price movements for buying decisions often leads you astray. The tail wags the dog. But here's where this gets really interesting. And honestly, this changes everything you thought you knew. The premiums you pay aren't just dealer greed. They're actually revealing something important about market stress. When physical premiums spike dramatically above paper prices, it signals that real people want real metal, not paper promises. This happened in March 2020 when premiums exploded to 60% on silver eagles. Paper silver said $14. Physical silver demanded $22. That gap was the market screaming that paper and physical had divorced. Kitco showed you spot price. Reality showed you something different. So here's the contrarian insight. Instead of viewing premiums as pure cost, view them as market intelligence. Extreme premiums indicate extreme demand. Compressed premiums indicate opportunity. You're not just buying gold. You're reading the market's fear gauge. And that information advantage is worth more than the premium itself. Now let's talk about the storage question, because this is where people hemorrhage money silently. When you buy physical gold, you have three options: home storage, bank safe deposit box, or third-party vault. Each has hidden costs most calculators ignore. Home storage means insurance riders, security systems, and the psychological burden of having substantial wealth accessible. Safe deposit boxes seem cheap at $50 to $200 yearly, but they're not insured by FDIC, and accessibility during banking crises is questionable. Third-party vaults charge 0.3 to 0.8% annually, which compounds devastatingly over decades. On 100,000 in gold held 20 years, that's 6,000 to 16,000 just in storage. And here's what Kitco won't emphasize. Their pool accounts and certificate products have their own fee structures. The convenience cost adds up. Before buying any gold, calculate your 10-year storage cost. If you haven't done this math, you're planning blind. So here's where I reveal exactly where your money goes when you buy gold. Let's trace a 1-ounce gold eagle purchase at $1,900 spot. Mint premium to dealer is around $50. Dealer markup adds 60 to 100 more. Credit card processing takes 2 to 3%. Shipping and insurance another 15 to 30. Total premium often reaches 8 to 12% over spot. You pay $2,100 for $1,900 worth of gold. But wait. When you sell, the dealer buys below spot. Usually 2 to 4% under. So your round-trip cost is actually 12 to 16%. That's $280 to $300 on one coin. For gold to be profitable, it needs to rise 16% just to break even. This is the math dealers hope you never do. But now you know. And knowing lets you negotiate, time purchases better, and choose lower premium products strategically. Information is wealth. Now that you understand the cost structure, let's talk alternatives that slash your expenses. First, generic rounds and bars carry far lower premiums than government coins. Same gold, less collector markup. Second, compare multiple dealers religiously. Price differences of 5% or more exist for identical products. Third, consider timing purchases during low attention periods.